Hey there everyone. Today, we're going to be talking about the banking system, from zero to hero. If you're like most people, you probably have a bank account or two, but have you ever stopped to think about how banks actually work and make money? Well, you're in luck, because that's exactly what we're going to cover in this video. So, let's start at the beginning. A bank is a financial institution that accepts deposits and makes loans. When you deposit money in a bank, you're essentially lending money to the bank, which it then uses to make loans to other customers. Banks make money by charging interest on these loans, which is higher than the interest paid on deposits. It's kind of like the bank is the middleman, borrowing money from some people and lending it to others, and making a profit in the process. Now, there are different types of banks, including commercial banks, investment banks, and central banks. Commercial banks are the ones that most people are familiar with, as they provide services such as checking and savings accounts, loans, and mortgages. Investment banks, on the other hand, specialize in securities trading and underwriting, while central banks oversee monetary policy and regulate the banking system. In the United States, the central bank is the Federal Reserve, which is responsible for setting monetary policy and regulating banks. The Fed influences the economy by controlling the money supply and interest rates. It's like the big boss of the banking system. But let's get back to how banks make money. Banks are required to hold a certain amount of reserves, which is a portion of their deposits that they must keep in cash or with the Federal Reserve. This helps to ensure the stability of the banking system and prevent bank runs. A bank run is when a large number of customers withdraw their money from a bank all at once, which can cause the bank to run out of cash and collapse. That's definitely not a good thing. When a bank makes a loan, it creates money out of thin air. This is because banks are allowed to lend out more money than they have in reserves, as long as they can expect to receive repayments from the borrower. This process is known as fractional reserve banking. It's kind of like magic, but it's actually just banking. Banks make money by charging interest on loans and paying lower interest rates on deposits. The difference between the two is known as the spread or net interest margin. Banks also make money from fees, such as overdraft fees and ATM fees. So, next time you get hit with an overdraft fee, just remember that's how the bank makes some of its money. Another way banks make money is through investments. Banks use the money they receive in deposits to invest in various assets, such as stocks, bonds, and real estate. These investments generate income for the bank, which can then be used to pay interest on deposits or fund loans. One thing to keep in mind is that banks are subject to regulations to ensure they operate safely and soundly. Banks are required to follow laws related to lending practices, disclosures, and anti-money laundering measures. These regulations are in place to protect customers and maintain the stability of the banking system. So, there you have it. A brief overview of the banking system from zero to hero. I hope this video has helped you understand how banks work and how they make money. Remember, banking is an important aspect of our economy, and understanding it can help you make better financial decisions. Thanks for tuning in. If you have any questions or comments, feel free to leave them below. And don't forget to subscribe for more informative videos like